Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me is Sonal Bhutra, and now it's no longer a quiet, sort of a consolidation session with IT doing well. Markets in the last 10 minutes have skyrocketed. They've literally taken off, and now we're at new highs. 24,500 scaled on the Nifty. The Sensex is well above 80,500. In fact, the ticker shows 80,600 on the Sensex. And that up move in the last 10 minutes, pull up that intraday chart, literally came out of nowhere. And it's large cap IT, which is doing the heavy lifting, because the mid cap index is still up close to about 0.3%. It's the frontline index led by IT names. So something like a Tech Mahindra is now up close to about 3%. TCS is up 4.5%. Since morning, it was up about 2.5%, but now the rally has extended itself to a 4.5% up move. LTI, Mindtree, Wipro, Infosys, there is just this burst of energy which has come through into the large cap IT names.
It's suddenly the markets have had an energy drink, right? And they're like, let's go for it.
Let's go. It's a Friday.
Let's just go for it and make the bulls happy. And that's exactly what has happened. You pointed out the IT space doing well, and that's definitely the cause of the uptick that we're seeing in the markets right now. But look at something like a Reliance Industries. That's also at the day's high. The stock is up around 1% right now, and a huge heavyweight on the index, right? So that sharp surge, and that is one of the reasons as well that why we are seeing that big uptick on the Nifty right now. Banking index, the banks were in the red, the Nifty bank that has also surged into the green. And look at that, it'll come just after this Nifty chart. Nifty bank has seen a sharp surge. So IT and banks that have led to the sharp surge from the lows. So you have something like an IndusInd Bank, which is at the day's high. SBI also is at the day's high. Consumption names they're contributing. So all of them have come together, and they are like, let's buoy the sentiment.
Let's finish this week on a high note.
And it's been a sudden surge. Nobody would have just thought the kind of up move we have seen.
Even HDFC Bank and ICICI Bank, both these two stocks have also seen that big up move in the last 10 minutes. But top honors today go to TCS and the entire IT pack. So let's quickly run through some of the big positives which have got the street excited when it comes to TCS. One, revenues and margins have beaten street expectations. Just to recap, the top-line revenue growth was 2.2%, higher than consensus expectations. Margins fell because of the wage hike impact, but the decline in margins was not as bad as what the street was fearing. Secondly, net hiring for the company turned positive after 3 quarters, and this is the highest that we've seen in the last 7 quarters. The third one is, stress sectors like BFSI, which have been clocking quarter-on-quarter negative growth, this time have shown positive growth. It's not a big growth, but at least they've turned positive after 5 quarters of a decline. Fourth, management has reiterated that FY25 will be better than FY24. And fifth, while the overall deal wins are muted, the AI pipeline continues to surge. The AI pipeline is now at $1.5 billion versus $900 million in the prior quarter, so that's a big jump. That said, there are still some concerns. One, the deal wins this quarter have declined 20% on a year-on-year basis, and there were some delays in closures of contract. And secondly, and I think this is where some people in the street are disappointed, is that the management still doesn't sound very positive. Okay. They have not come out and thumped the table despite a good start, a good Q1, that things are turning around. There is a pickup in demand. They're still saying things are very, very cautious, which is the case. But I think that's something which has disappointed the street, because if you back these numbers up with a pickup in sentiment, and then the stocks can do very well. This is what the stock is currently trading at, 25 times forward multiple. The Nifty IT index is also at a 4-month high, and individual stocks have started doing well now as we speak. But let's get to the top management speak then at TCS. We chatted with them earlier today. Listen into excerpts from that conversation.
We had a 170 basis points impact on account of the annual wage increase, which we give typically at the beginning of the year, and as usual we have done that. And in the past, it has ranged between 150 to 200 basis points. Subcontractor expenses, it's at 4%. Yes, it's been a decline. I'd called it out. We see it bottoming out. I do feel it would bottom out, but it would also depend on how the overall demand scenario plays out, and how the supply scenario. So typically subcontractor is short-term demand supply mismatch, and if we need to optimize it, we still have 4% to optimize it. But relatively, as I had called out last time, we would expect it to be stable around this number.
We have mentioned many times that our comfort range is 7 to 9 billion.
Okay.
And every now and then you get something lumpy, it goes beyond 10.
Got it.
And other thing we look at is what's our overall pipeline. Our pipeline continues to be very healthy. And whatever TCV we declared last quarter, we've been able to replenish in the pipeline. So our pipeline is back to where it was. And it's more a question of timing. The TCV is more a timing question. It always will be lumpy. And any mega deal comes, it will skew it. But
And what's the AI pipeline? I remember last quarter you all shared a number of $900 million.
$1.5 billion.
$1.5 billion.
Yes.
That's a phenomenal growth rate in the AI pipeline.
Yeah.
All right, that's the word coming in from the TCS management, the stock surging and lifting the entire market along with itself. Let's dip into a short break. Up next, we'll discuss what's buzzing in the commodities space with Manisha Gupta. Stay tuned for that. Welcome back. You're still tuned into Trading Hour. Record high for equity markets. Let's talk about commodities now. Manisha Gupta is joining in, and today we are focusing on precious metals. Manisha, tell us more.
Well, thank you for that, Sonal. It's also gold, which is inching very close to its all-time highs of $24.50 an ounce. So we are holding around $24.10 at this point in time. Gold prices have gained up by 16% in this year until now, outperforming various other asset classes. Well, not just gold, silver prices also jumped up by 2%. They're trading at a 6-week highs as well. The U.S. inflation data for the month of June coming in lower at for a third straight month at 3% is something that clearly has been supportive. And now the U.S. Fed rate cut possibility has inched up to nearly 85%. Also, when you look at various banks and brokerages, they have reiterated higher gold prices for the rest of this year and in 2025 as well. TD for one says that by first quarter 2025, you will have gold prices trading at $2475 an ounce. Citi has spoken about 2400 to 2600 by the end of this year. Bank of America says that 2200 is where the gold prices will average. You have Deutsche Bank talking about 2400 by the end of this year. And it also is JPM talking about $2,300 an ounce. UBS is talking about $2,700 by mid-2025. So clearly, barring a couple of banks who still believe that $2,200 could be an average for this year, the others are talking about $2,400 and up till $2,700 on the higher side for next year.
Thank you very much for that. There's also some important domestic macro data that the street will be awaiting. That's the June CPI inflation and the May IIP numbers. Will come out post-market hours. Lata has joined us in the studio with the expectations. Lata.
Well, the CNBC-TV18 poll says that it will be 4.9, but I would rather put it at 5. It's, there are a goodish number of polls, or rather respondents, who are expecting it to come closer to 5 as well. So it's actually 4.94 to be very precise. And that compares with 4.75 in May and 4.8 year ago June. So it's it's actually 5% over last year's 4.8. The core CPI is seen at 3.1, the same that it was last year, last month. And that's been, steadily lower only. A few people think that it may have bottomed out, but that's not the majority opinion at all. Food CPI is the one that everyone is worrying about. 8.6% is the average that I have got. There were some 8.7s as well. This is largely vegetables driven, as it was in May as well. In May, what went against the number, although it was a benign 4.75 overall, vegetables and pulses were still around 17%, and vegetables have probably gotten worse in June, as all of us would know. I mean, tomatoes went to 120 to 150. So, that is going to tell on the inflation number. That's why some people are guessing 5 at the headline level. Fuel, housing and clothing have been weak, and they are expected to remain weak. The IIP number is, not that much watched because policy is not made on IIP. It's CPI which is more important. IIP is seen coming at about 4.6 compared to 5 year ago. And there some weakness is anticipated in manufacturing. Manufacturing, even in April, grew only by 3.9. And chances are that's going to remain under pressure. Electricity did very well from what evidence we have so far. But these are lagged numbers. We will concentrate more on CPI. The chances are that this is not going to move the needle much in the bond market, even if it came to 5.1 or something, because the governor, speaking to CNBC TV18, quite clearly said any rate cut hopes are premature. So although the US CPI numbers are clearly indicating a downward trajectory and the CME Fed watch over there is voting 85% for a September cut, the governor's categorical statement yesterday to CNBC TV18 that rate cut hopes are premature at this juncture and the CPI even in June is expected to come around 5 will mean that the bond markets will look at this number, but I don't think it has a market effect.
Okay, thank you so much, Lata, for joining us with what to expect from these important numbers. Let's take that conversation forward. Lata spoke exclusively to the RBI Governor, Shaktikanta Das. He spoke about a whole host of things, stock markets, proposed tightening of project finance rules, extension of his tenure, and a lot more. So listen into a few excerpts from that conversation.
Whether it is stock markets or the bond markets or, so many components are there, so many segments of the economy. We look at what spillovers they will cause. Now, so far as the banking sector is concerned, we are very closely, we monitor all banking, meaning the credit sector or the credit growth, all that is, this segment is concerned. We very closely watch this position. In fact, much closely than it was, a few years ago, much more closely than a few years ago. And whenever we see possibility of whenever we see some early signs or whenever we feel that a few months down the road there could be a problem in this particular sector or subsector, we act. And an example is the unsecured credit where we took action last year in November. And we increased the risk weights and the results are there to see.
Okay, that's exactly what I'm saying. See, the F&O volumes was something that troubled government, RBI and SEBI. And SEBI has appointed the Padmanabhan committee on it. So do you have this fear that bank money could be fueling the stock market rally? And therefore, is there a case for higher risk weights or even to keep the interest rate, on watch?
You see, so far as bank money going to sort of create some, giving some boost to the stock markets, etc., is concerned, the exposure limits of the banks to the stock market, individual borrowings from, let us say, NBFCs, which were very high earlier for participating in IPOs or for going to the stock market, the IPOs or for FPOs, whatever. Even there we have put a limit of 1 crore. It was all done some 2 years ago. It's not something we did yesterday. So therefore, at the moment, so far as from the point of view of the credit sector, there are no major concerns.
Okay, you don't think fresh controls are needed?
And in any case, banks have their own, end-use monitoring. Only some amount of, some amount of unsecured credit may go into the stock market.
Exactly.
May go. But so far as unsecured credit is concerned, we have already come out with, we have provided for additional risk weights and the overall growth of unsecured credit has started moderating.
So you don't think more is needed?
That I cannot say. As and when something is, because it all depends on the numbers and the future outlook. So we keep on constantly evaluating. As and when some measures are required, I can assure you that the Reserve Bank will be proactive.
Okay. You're not done with risk weights?
Depends on how the situation plays out.
Let me come now to the banking sector questions. The two obvious things that the market is waiting for from you is this project finance provisioning. You have raised it to, you want it raised to 5%. And once the project is completed, even then it is coming only to 2.5%. Standard loans is only 0.4%. So you're really asking for a very big provisioning. Is there any chance it will be softened?
You see, what we have given out is a draft circular.
Yes, it's a draft.
In fact, we are now adopting in our regulations, we are adopting a very consultative process.
Yes.
And in fact, in the annual report also, if you recollect, or you may have a look, or your viewers may have a look. In the annual report for, last financial year, there's a separate box item, there's a separate annex, where we have listed out all the regulatory measures which we have taken, the number of regulatory measures which followed a consultation with the stakeholders. Okay. So we are now actively consulting. There is a consultative approach for regulation making. So this is also a part of our consultative approach. What we have put out is a draft circular. We have started receiving comments, and based on the comments that are received, we will examine the comments and then we will come out with a final circular. The purpose of the draft circular is to adopt a consultative approach to get out external inputs and examine them with all seriousness.
See, this is not a discussion paper. This is a draft regulation. It's
circular.
almost ready to
It's
go.
a draft circular.
So the fear of the industry is that you won't tweak it much.
It is a draft. We have said
it is a draft.
So when I say it is a draft, I am not saying that we will not tweak much, or I am not saying we will tweak it so much. It's a draft circular, and our approach is consultative. We take this consultative process very seriously.
3 members, external members, their last meeting is in August. And then I think your term is December, Patra's term is till January. The whole MPC changes. Not just for that reason, but that is a very good reason to continue you. So that there is continuity in the MPC and, you know, a job well done. Why should the government disturb? Have they intimated to you anything at all?
So it is like
we would like you in Mint Street. That's why I'm asking.
It's like this. When there is an assigned, you see, first thing is institutions are bigger than individuals. Whether it is the Reserve Bank as an institution, or it is the monetary policy as an institution, the institution is bigger than the individuals. The institutions develop their own momentum, their own discipline, their own principles, guidelines. So institutions will always continue to function. Now coming specifically to this thing, you see, when I am on a particular job, I focus on that job. I am not distracted by other things. Or to use the analogy of cricket, when I am out there batting, I rather focus on my batting and not think whether I am there in the next match or not. So it's that way.
But they have not intimated anything at all about, you know, the post-December person in RBI or your position. No intimation at all from the government.
No, I think, you know, it's again, I mean, the question is, I think I said it elsewhere also. As I told you, I'm just focused on my batting currently.
Okay.
Indication, no indication, it doesn't matter to me at all. I am currently in a job. My focus is completely on that job. I try to follow the principles of Arjuna, remain continuously focused on the job at hand, and not get distracted by anything else. And I'm not saying it to sort of make it a kind of a cliched answer or anything. This is what I really mean.
Okay, we'll slip into a break on that note. When we return, we'll discuss market technicals. Mitesh Thakkar joins in next. Welcome back. Brokerage house Motilal Oswal has upgraded ACC and Ambuja Cement to a buy. Nigel joins in with more on that. Nigel.
Well, that's right. Let's start off with the stock calls first. On ACC as well as Ambuja, they have gone ahead. They have upgraded the stock to buy from neutral earlier. And the target price should come up for you in the screen. So on ACC, it's around 3,300 rupees. On Ambuja, it's around 800 rupees. They continue to remain their positive stance on a whole host of stocks. And they have been positive on some of these names for a while. Ultratech Cement, JK Twins, JK Lakshmi Cement, JK Cement, Dalmia Bharat, as well as Birla Corp. While they have their neutral rating on a couple of other names, that includes Ramco as well as Shree Cement. Now, they're given broadly 4 points. So that's the way I've categorized it. One is they're highlighting this consolidation theme. They're saying the larger players, they want to get larger. And some of the smaller players, they may give in to if there's a good offer that's on hand. So they're expecting consolidation to continue, and they believe that's the next big theme that will play out. Then they focus on the clinker addition, you know, in the coming years. And they're saying out of the total 78, 79 million tons of clinker that will be added, close to around 72% will be from the top 4 players itself. So this consolidation theme is going to gain pace because of inorganic growth, and the capacity addition is by the larger names. Point number 3, they have highlighted the improving capacity utilization levels. Between 2013 and 2023, it was roughly at around 70%. That's moved up to around 78%. And now they forecast it will go to around 81%. And finally, they're talking about green power as a percentage of the fuel mix. And that's what's going to help in reducing cost. So they're given a few numbers. In 2015, it was in single digits. In 2024, it's moved to 35%. And they say it moved to around 50%. So those are the big 4 points that Motilal Oswal has put out. Back to you.
Okay, all right. Thank you so much, Nigel, for bringing us all those details. So that's Motilal Oswal's take on ACC and Ambuja Cements. LT Foods, that's the other stock on our radar. It's buzzing in trade. The company has expanded footprint in United Kingdom to inaugurate a facility to tap the rice market there. Vamakshi joins us with all the details. Vamakshi, what's the investment? What's the market size here?
Well, absolutely, Sonal. We'll get to that. But, keep in mind that the company had already announced in the analyst call gone by that they will be opening up this facility in the UK in the month of July, and that has come through. They, like you rightly pointed out, they are expanding their footprint. They've inaugurated a facility in Harlow, and this facility has a capacity of manufacturing, of 60,000 tons of rice per annum. And with this, they're aiming to tap the rice and rice-based food market in the UK, which is pegged at almost £1 billion. In fact, the investments in these facilities, they said that they will be making an initial investment of around £7 million, which is approximately 75.5 crores. And they also have a further commitment up to almost £50 million in the coming years. The company has also laid out a revenue generational potential of the company. They said that the company has already partnered with 4 leading retailers in the UK, and they plan to scale this up further. They're expecting annual revenue to the tune of nearly 50 million pounds, which is approximately 539 crores in INR, and this could be generated over the next 2 years. But apart from that, they're also targeting nearly 100 million pounds worth of revenue within the next 5 years, which roughly translates to around 1,100 crores worth of revenue over the next 5 years for the company. So overall, this development bodes well both for L&T Foods.
Thank you very much for that. Let's get to the market technicals then. Just shy of the 24,500 mark, up 166 points. Mitesh is now with us for a quick technical check on the markets. Mitesh, we had that big surge, a burst of energy about 30 minutes back, but it's still holding up smartly, 0.6, 0.7% up. Yeah. What have you made of the day, the trends? Is this sort of a mini breakout?
I think, we kind of managed to get past the 24,500 mark and then we come back below it. There's some option concentration on the call side at 24,500. So that might be slightly difficult to get past, but otherwise the structure looks pretty okay to me. And while, there was a chance of consolidation, we are still not seeing that. I think what could be interesting is the Bank Nifty could start getting past 52,700, 800 levels. I think we got an intraday high, but then again, the Bank Nifty is cooled off. If that picks up, then I think, the Nifty should pick up as well. So stay positive, stay on the long side. But the focus still remains on the stock basis.
Yeah, so the markets have come off from the highs. So Mitesh, in that case, stock specific, what would your bets be?
I have a buy on Wipro with a stop at 545 for targets of 565. That's open with a gap up today and seeing good continuation follow through on the upside. So that could do well. And Tech Mahindra is a buy with a stop at about 1484 for targets of 1540.
Thank you very much for that. We'll get into a break. On the other side, we'll put the spotlight on UPL, HCL Tech, and find out why they're on our radar.
Welcome back. You're still tuned into Trading Hour. Let's quickly take a look at the Nifty. It's up around 180 points. The Bank Nifty is up to 76 points, but it has come off sharply from the highs of the day as well. So just watch out for that one, and it is largely led by Bank Nifty. So those charts actually are mirroring each other. So Bank Nifty as well up around 300 points right now. But let's talk about some stock-specific news. UPL, that's the stock on our radar today, because remember, BASF, one of the biggest chemical producers in the world, they've gone ahead, they will discontinue glufosinate ammonium in Germany by 2024-2025. They say it's because of economic reasons. There are high energy costs, there's more competition, and that's why they'll be shutting 2 of their capacities. One of them is in Frankfurt. They will cease the production, and this will happen over a period of time, of course. So by next fiscal, they'll be completing this process as well. Now remember, glufosinate ammonium remains a key component of their global herbicide portfolio, and they say a number of reasons. First, there's rising competition from generic manufacturers, there's alternative technologies, as well as their high energy and raw material costs as well. It just goes on to show that when one of the biggest producers is talking about high energy costs, high raw material costs, it just means that there are still a lot of headwinds in the sector as well. It could impact UPL in 2 ways, because UPL is a major producer of glufosinate as well. It could either impact them positively if they catch on to this supply constraint, they actually cater to this bigger market, and if prices increase, they can benefit from it. But secondly, if raw material prices, energy costs are impacting something like a BSF, it could also impact UPL. But again, we'll have to see which way things go, considering that UPL has a big base here and they can actually go ahead and expand it further. All depends on raw material costs and how the supply chain also functions in this case, Reema.
Okay, that's about UPL. Let's move on then to HCL Tech, because HCL Tech will be reporting their numbers. So after TCS's strong Q1 performance, the question is, what will HCL Tech deliver? Well, the expectations are fairly muted because this time we are working with a 2% revenue decline, and this is pretty much guided by the company. There are two reasons why the top line for HCL Tech will fall. One, a large project of theirs went offshore. You earn less money because of the offshoring rates being lower than onshoring. And secondly, the productivity benefits are passed on to customers. So that's the reason why top line will fall. That puts pressure on the company's margins. So despite no wage hike, margins will decline and profits are seen down about 5.5%. Expect the company to maintain its full year guidance, 3 to 5% on the top line, 18 to 19% on the margins. But I think what the street in the commentary will want to see that how will you maintain this guidance? Because in Q1, you're likely to have a negative growth of 2%. In Q2, there is going to be an impact because of the divestment of a JV that they had done. That will hurt them by 100 basis points. So there are skeptics on the street about how this company will achieve its full year guidance. Also, the outlook on deal wins. Remember, TCS's deal wins were a bit patchy. Yes, they get lumpy, but even for HCL Tech last year, the deal wins, ex of that large deal that they had with Verizon, were fairly muted. So I think these are some things to watch, but expectations clearly have been elevated. 3% up on HCL Tech.
And after what TCS delivered,
Exactly, yeah.
sequential improvement, let's see which way things go for HCL Tech. But let's move on to an exclusive now. Sources are telling CNBC-TV18 that city gas distributors are seeking parity between taxes on natural gas and those on LPG and electric vehicles in order to be price competitive. Sapna is joining us on the phone line to tell us more. Sapna, what are you picking up?
Well, that's right. This has been a major ask since some time, and now it's catching traction because of the fact that the market is getting increasingly segmented between various kinds of fuels. So, very quickly, basically the city gas companies have been asking for a waiving or a standardization of the high VAT rates, both on CNG and PNG. They are very clear on the fact that the VAT rates are the ones which are resulting in the cascading effect as far as the final costing of the consumers are concerned. Convenience is not enough to encourage consumers to switch to PNG because here there is a direct competition with LPG. LPG rates are at 5% under GST already, but that's not the case with natural gas so far. Having said that, look at UP, for example. I mean, UP levies a 10% VAT on CNG purchase without ITC, and on top of that, 12.5% on sales as well. So the purchase and sales, you club both of that, and then you have a 14% central excise on top of that. You have a rate of around 22 to 23%. Similarly, in terms of, so basically the ask here is not only a reduction in the central excise duty of 14%, but also parity in terms of the tax rates with LPG and the EV, because these are two segments which are impacting the CGD players. So going forward, what they're indicating is that even if the excise is waived completely by the government, it will just be a hit of around 8,000 odd crores. Totally they earn around 2.70 lakh crore to 2.80 lakh crore is the rough number in terms of the central government's earnings in terms of petroleum taxes. So 8,000 crores over there, industry is saying is not a big number, looking at the fact that the kind of benefit it will have on the market. Last but not the least, they're also asking for waiving the road tax and registration charges of PNG vehicles. This is again in line with the EV, and as I just mentioned about the competition with the LPG segment, they also want to create, the government to create LPG-free zones where PNG network is available. So it's a big ask by the CGD players. We have to wait and watch and see how much of this really works out, because VAT rates are something with the state government, central excise. Well, let's see what happens in the budget. But there are other asks as well. So put together, it's a tall list from the players, and we have to wait and watch and see how this really pans out over the next 1 year or so.
Absolutely. Thank you so much, Sapna, for joining us with all those details. You know, Reema, yesterday we spoke to Mahanagar Gas and they did indicate that, yes, there is a possibility and there have been conversations in the industry as well about an excise duty cut. And if that goes by, if the current rate is around 14.4%, if that goes by, there is a 5 to 8% cut, they can go ahead and take price cuts of around 3 to 5 rupees per kg. And if that is passed on, that could bolster their volumes as well. With VAT as well, that would be the same story. Of course, each state has a different VAT number. The cascading impact is something that hurts their pricing, is what the CGD company says. So it'll be a wait and watch, but if it does come through, it'll definitely be a relief for their volume. So city gas distribution companies continue to be in focus. Let's take a short break. Up next, we'll discuss market fundamentals with Santosh Singh from Motilal Oswal Asset Management. Stay tuned for that conversation.
Welcome back. Let's talk markets and where we're headed from here. Santosh Singh, fund manager at Motilal Oswal Asset Management, is with us on the show now. Santosh, morning. Thank you for joining in. Before we get to individual sectors, first, your view on the markets.
See, the markets, I think we are in a phase where we are not going to see big returns from the market. That's my view for some time, at least for 6 months to a year. We are not going to see big returns unless and until we see such significant amount of policy changes happening. Now, because the valuations have reached a level where the EPS growth may not be able to keep track with the our expectations. So that's one part. And secondly, I believe that there are segments in the market where the valuations have gone slightly higher than my understanding of the market. So I would say I don't see a big decline in the market, but I don't see a big upside also in the market as of now.
Okay, so some of the valuations are concerning. Santosh, good morning. So in that case, I just wanted to understand the fund manager's perspective. In a market like this, where we're seeing sectoral moves, we are seeing peak valuations, what is the reason we are seeing so many sectoral funds come out? Is there still a pocket where fund managers are seeing a lot of valuation uptick still left? For instance, defense, for instance, you have the automotive space. What is your take here?
See, there are a couple of reasons why you're seeing sectoral funds, because you have seen these sectoral funds happening in the past also when the sector has been doing very well, right? And it's the government focus on those particular sectors sometimes which causes the funds to come in, because sectoral funds as such are also a bit volatile, and then they can give you higher returns as well if the sector does really well. So what we are seeing is that the sectors where there is a lot of government focus and where the government wants to grow that focus for Indianization or something, then we are seeing some new funds which are coming up. And I think it's very focused on few sectors. It's not that we are seeing some large sector focused funds, right? Some of the largest sectors we are not seeing focused funds like IT or banking.
So in your portfolio, Santosh, where does technology stand? Are you neutral, overweight, underweight? And does TCS's Q1 performance change the narrative on IT from here on?
So, see, I tend to be slightly contra in my investing, so that my portfolio is slightly overweight IT, so that's one part. And then the reason is simple, that a lot of segments of the market we have already seen doing very well, and the valuations have gone ahead of my my levels where I can invest. So this is one sector which is a lot more driven by the interest rate cycles, the global interest rate cycles, and the global economic cycles. And we have seen that this is a sector which has seen significant de-rating over last couple of years. So my view is even a small bit, and then what you saw in TCS was not that I was not really excited by the results. It was not that it was out of the world. Right, but even a small bit of positivity is causing these stocks to go up like this. Simply because you have seen so much negativity over last couple of years in this sector when the market is going through on a daily basis making new highs.
And yeah, exactly. So that sequential recovery, that even slight outlook is something that the street seems to like. Is it the same case for mid-cap IT? Where are you comfortable with valuations there, Santosh?
So again, mid-cap IT has very different segments, right? What has done really well in mid-cap IT are some of the product companies rather than really the software companies. So, and then mid-cap, and then this is one area where I think IT has been the only sector where mid-cap and large-cap has performed really differently. So in mid-cap, I think if the growth rate remains where they were, right, because some of these companies have shown significantly higher growth rate than what we have seen across the, if the growth rate remains where they are, we might see the performance, they're doing well in future as well. But I would say that means if the cycle turns around, then it's better to be in the large cap than in the mid caps. If the expectation is that the cycle is still not turning around, then mid caps can still keep doing well.
But what is your view? Is the cycle turning?
So my view is that it might take another 1 year or so before that we actually start seeing a turn in the cycle. But the market tends to see only signs of it, right? When the downside also started, it didn't start when we see actually TCS reporting bad numbers or actually reporting we actually started seeing a downward revision. It started when we started seeing the interest rate yield curve getting in a different direction. And then if the interest rate yield curve again, we start seeing a rate cut, we might see the recovery happening in the sector later on, but the stocks might start doing much better before that.
That's about the IT space. The other sector I wanted to understand your take on was the energy space. We're seeing a huge surge. That has been the case. Again, when I talk about launches here, energy funds, they have been the talk of town again. How are you looking at the entire energy landscape? Do you think things are turning for the best here? What do you like, it be the gas utility space or the explorers and producers? What's your take?
Energy, if you see, there are three parts to it, right? The oil and gas part, the power producers, or the equipment suppliers. These are the various parts in energy space, right? And what you've seen is that most of the segments, from transmission to producers, everything has done really well over the last couple of years, and that's based on the expectation that there is going to be a revival, one, in the overall space. Second, the ESG concerns which we used to have on some of the producers, given that they consume coal, has gone off, right? From the time of Ukraine war, we are not seeing too much of ESG being talked about. So that concern and that discount has tended to gone off from this sector. And thirdly, we are seeing a lot of revival as well. So these stocks have done really well there as well. Now, if you ask me that from here on, I'm not too much comfortable with large bets in energy, given the sort of valuations they are.
Okay, so not comfortable with valuations. That's what I wanted to understand, because the general consensus also is that they're still trading at reasonable valuations. They are still lower than the 5-year averages that we've seen. At least I'm talking about the oil and gas space, not exactly the other power or the utility names as well. Santosh, your word on chemical space as well, because, I was going through a lot of reports which suggested that maybe recovery started right now. Our conversations with management have suggested that maybe the worst is over, but still it's not pricing into the chemical names yet. What is your take?
So let's get into the history of chemicals, right? Around 2010, we used to say that this is a 10-15 PE stock, right? This is what, because these are all commodities and they should trade at 10-15 PE. Somewhere closer to 2020, we started talking about that it should trade at 50 PE because these are specializations. And there is an away from China and India story coming in. And suddenly, for the last 1 or 2 years, the sector has not done well because the pricing has not been favorable to them. And also the demand, the supply scenario has not been favorable to them. Now what we are again seeing is that the pricing has started to recover a little bit. That's the sign which is which is coming up, that the pricing has started to recover. And this is a sector which is a global sector, if you see that way. And so that's where, if this sustains, then we might see a recovery in this particular segment, because again, this has been a vast underperformer over the last couple of years, from a sectoral perspective. It has been underperformer over the last couple of years. So if we see a revival in the pricing and it's sustaining over next 6 months to 12 months, then we might see a good uptick coming here.
So are you overweight on specialty chemicals? Do you hold any of them? Because you are a contra player, as you said.
No, I hold a small quantity here. I don't hold large quantity. Yeah.
All right. So where else have you gone, contrarian to market perception?
I held a lot of health insurance.
Health insurance.
I don't hold any banks. So that's I hold very
So
little.
you don't hold any banks and you hold health insurance.
Yeah. So clearly the view is that for the best part of the market, the banking segment, which was the net interest margins increasing or the credit cost getting better. So we have seen the best part of that. And if the interest rates we see a cut in that the net interest margin at least can shrink from here on. And that's where I think we are not going to see the best of the earnings is behind us for maybe next 6 to 12 months. And my belief is that if the best of the earnings is behind us, we can wait for next 6 to 12 months before again getting into the banking. But at the health insurance side, if I look at, see, the companies are doing very well, but the stocks are doing very badly. So if the companies are, we have seen over a period of time that the stocks tend to only follow earnings, and that's my belief, and I tend to follow only earnings, and the stocks tend to follow only earnings. So if the earnings are doing so well, and if the stocks are not doing well, then it tends to give you a sense that in a market where everything is so expensive, you might rather want to be there.
Okay, we take that point. Santosh, it was a pleasure speaking with you. Thank you so much for joining us today with your perspective on the markets and individual sectors as well. Time for a break now. When we come back, we'll get you more on the markets on the other side. Stay tuned. Welcome back. You're still tuned into Trading Hour. Well, the markets have come off from the highs. Nifty around 90 points. The high today was 24,592. It has come off from those levels, but again, it's a day in the green. That continues to be the case. We have the likes of Reliance Industries, ITC. They were supporting the markets, of course. They continue to do so, but still, these stocks are the reason why we've seen that fall from the highs as well, including the banking index. That one is up around 270 points. But again, this index has also come off from the highs. With that, we'll wrap on this edition of Trading Hour. But as we do that, top business leaders and newsmakers gathered at the CNBC-TV18 CII Budget Town Hall to put forth their expectations from the upcoming budget. A higher capex allocation to spur consumption, incentives to boost skilled manpower were some of the demands put forth by the industry. India Inc. also pushed for the sunset clause on the 15% concessional tax scheme for the new manufacturing companies to be extended by 5 more years. Listen into what Sanjeev Puri, President CII, Sanjeev Bajaj of Bajaj Finserv and R. Mukundan, Vice President CII, had to say at this major event.
Consequent to COVID, we have seen the cost table, and a lot of it because of external factors has actually gone up. And because of that, there is a challenge on consumption across the world. As far as rural is concerned, given that cost of everything has gone up, what CII is recommending is that the amounts through direct benefit transfer, the amounts through Manrega and income tax at the lower end, below 20 lakhs, there should be some relief in, and all the other areas should be increased.
Our last 5 years have seen the early benefits of schemes like the PLI scheme. There have been some mistakes along the way also which need to be corrected. I hope we see a version 2 of that, and while we know the budget is for the year, but I hope there's a direction for the next 5 years. What industry needs is a clear glide path of what to expect over, say, the next 5, even 10 years, so that they can invest with confidence. Second, around jobs, having jobs and skilling. We were just talking to somebody over lunch, and you can't get people, because most people have gone home, and how do you get them back? I think this is another big challenge for industry.
This 15% income tax sunset clause, if you can push it back by another couple of years or maybe give it a 5-year push, I think it's going to play extremely well. The external environment is positive today. If you look at the environment in terms of interest rate, they're going to fall. You go look at the, despite all the trouble in the world, energy costs are almost flat. You can't ask for a better environment, but we now need to capitalize and move forward.